Hi guys, good evening and welcome to Money Control. I'm Kavnya Rao and with me today is Ravi Krishnan from Money Control as well. And we're here to help you decode the numbers for India's Q2 GDP. Now, Ravi, thanks for joining in. And the GDP growth for the July to September quarter, which is Q2 of FY23, it has fallen to 6.3%. Again, would you attribute it largely to the waning of the base effect that was, in play for all these quarters? And would you say that it meets expectations, or is it actually something that is a bit of a surprise?
It's not a surprise at all. There are certain
Okay.
components of GDP and GVA where there are surprises. But if you look at the overall number, GDP growth of 6.3% is not a surprise at all. This is what the RBI had also forecast. When it had come out with its recent monthly economic update. And yes, it is due to the fading of the base effect because we knew that pandemic year FY 2021, there was a sharp decline, then there was a bounce back in growth, etc. After that. So that kind of has been playing along, and the base effect has now kind of faded off. If you look at real GDP growth, if you look at the real GDP of this July to September 2022 versus July to September 2019, the corresponding quarter in the last pre-pandemic year, it is overall a growth of 7.6% only.
Okay, but in isolation, a figure like 6.3 is, I mean, what sense should we make of it? Is it worrying for consumers, for investors, for people actively participating in the markets? What should we make of it?
Well, I think the fact is that it is meeting expectations. But remember that, and therefore, the economy is on track to grow around 7% for this whole financial year FY23. But that also means that growth from here on is not going to be easy. In fact, RBI itself has projected that growth in the October to December quarter and in the January to March quarter will fall down to around 4.6%. And that is also not too surprising because monetary tightening has happened. I think around 190 bips the RBI has tightened, has increased the repo rate, and I would expect that going by this data where growth is meeting expectations, and given that inflation is not totally under control, it will probably hike rates by another 25 to 35 basis points next week when the Monetary Policy Committee meets. So the effect of this tightening and the fact that global growth is also coming down, which will be a drag. India is not totally immune. There will be some effect of a slowing global growth and India's growth too. We will see the effects of this play out, and we will see, GDP growth coming down to around 4.5 to 4.6% in the next couple of quarters, and 7% this year. I think most economists are now talking about 6% in the following year, FY23.
Yeah. Yeah. In fact, another, alarming thing or a bit of a negative sign was the core sector growth as well, which came out ahead of the GDP numbers. In fact, October core sector industries slowed down to 0.1% in the month gone by. So it was at a, lowest level in last 20 years. So like you said, if the growth from here on is going to be tough, do you think that could hit the investor sentiment as well, or will the kind of capex and initiatives that the government has been taking and stepping up capex and spending, will that be able to offset it?
So we really need to see, where this is headed. I mean, today again, Sensex has catapulted to another high, unprecedented, uncharted territory, as somebody
Yeah.
called it. The fact is that I think India, when you look at the next 12 months, you look at price earning multiples, it is at some 86% of premium to the emerging market pack as a whole. So, the price is basically there is a sense of optimism around India's growth, that it will be relatively better off. Okay, the key word here is relatively. It will be relatively better off than most of the big countries in terms of economy, in terms of politics, and even in terms of how the geopolitical situation is playing out. I think that is what is leading to this optimism. One would also see, equity flows continuing, especially from domestic investors. Foreign institutional
Hmm.
investors are also returning, but we need to see how long this will play out.
Ravi, what does essentially the Q2 data tell us about the structure, the condition of the Indian economy as it stands? Because fuel prices remain high during the quarter, trade deficit remains elevated. Um, Net exports are still a bit of an issue. Yes, dollar index has cooled down, but still, it continues to be a bit of a pressure point for us. So, where does it place us right now?
See, you look at the components. See, one positive surprise has been agriculture. People were expecting that agriculture will not do so well because of erratic monsoons, the heat
Hmm.
wave, and all that. But agriculture GVA growth has been around 4.6%, which is even better than the April to June number of 4.5%. Industry has been a really big drag. When I say industry, that is mining, quarrying, manufacturing, electricity, and construction. It has shrunk by 0.8%. Manufacturing has also shrunk by around 4.3%. Basically, what does this point to? We saw weak corporate earnings in some sectors, and that has been one reason why industry has not done so well. But on the other hand, the services sector has really picked up. I think
Hmm.
growth of around 9.3% on a base of 10.2% growth
Hmm.
in July to September of the last financial year. And basically, contact intensive sectors have opened up because of the waning effects of COVID. Trade, hotels, and transport. GVA there has it grew 14.7% on a base of around 9.6% the previous year. That is pretty good growth actually. And overall services growth of 9.3% has what led to this real GDP growth of 6.3%. Because remember, net exports has been a big drag. Exports grew only around 11.5%, while imports grew at double the rate, around more than double the rate, around 25%.
Yeah,
So this gives us a glimpse of what is going to happen in the coming quarters also, especially on the net exports front, because already in October we saw exports shrink for the first time in many months.
and
So that does not quite bode well.
yeah, definitely, definitely. But given that typically we tend to compare numbers, data, and the state of the economy with how things were pre-pandemic, uh, was the September quarter GDP number able to give us a sense of whether we are back to those levels or there's still some way to go?
See, in many sectors, we have already exceeded the pre-pandemic levels, but that does not mean that everything pre-pandemic is that good. For example, manufacturing, which is around 17% of GDA. But again, it is not that, and it is about, if you look at September 2019, that was around 17.3%. But it is still below the peak of 18.3%, which was achieved a few years ago. Or that must have been 2016 or 2017 or something like that. On the other hand, if you look at something like personal, consumption, that is still accounting for a huge percentage of overall GDP. The shift we have seen during the pandemic, because consumption had kind of increased, and it still remains, at those kind of levels. Although it has come down a little bit when, say, compared to June.
Okay, all right. One question typically that everybody is asking us right now, even on our live feed, is how will the markets react to these numbers tomorrow? But not just tomorrow, but given the kind of signs that we have, let's say agri and services has done well, There's a push on capex clearly from the government side. Domestic facing companies uh, probably doing well than export oriented players. So are these the themes perhaps to watch out for the next few months as well, if this is going to be the trend going forward as well?
Yeah, see, I think the markets is not, they are not going to read too much into this data. I mean, this is old data. It is 2 months old, right? This is September quarter. The only thing we can do is to kind of read the tea leaves and see what are the clues, these numbers are offering. And what are those? Consumption is still holding strong, which is good news. But remember, pent-up demand can come down, because the effects of COVID are waning and, these revenge travel, revenge consumption, whatever those terms are, which people have been using now, we will see the effects of that fading. Exports, will come down. So we are actually seeing signs of those already. And services sector has done well. We need to see whether that continues. This time, this gross fixed capital formation, which is essentially investments, that grew around 10%. That is good growth. But demand, if it does not grow that much, then businessmen will not be putting up new factories. So we could see a slowdown there also. The capex cycle has not completely taken off as much as is expected. So these are some of the clues that these Q2 numbers are giving us, and we need to see how they will play out over the coming months. As I said, markets are now, flying in the
Yeah.
hope that India is relatively better placed than many other countries.
Okay.
And remember, the effects of monetary tightening will be playing out. So that will have different effects. Some are even saying that as bank deposit rates go up, domestic investors might not be so inclined to put money in the equity markets also. So we need to see how it plays.
So, since we get a lot of audience and viewers who are purely interested in markets and investing, from an investor standpoint, what are the parameters or perhaps macro factors that you would be watching out for? You would tell people to watch out for if they want to, track the macros and its subsequent impact on potential impact on the markets.
Well, I would look at consumption because India has always been a consumption-driven economy, and I will also see global growth and how this exports situation is playing out. Those would be a couple of indicators that I would track closely. Also, remember that I mean, it's an interplay of many factors because our deficit, current account deficit is rising. It's expected to be around 3.6% this financial year, according to some estimate, 3.6% of GDP, and that could put pressure on the rupee. But thankfully, the external situation is not so bad because import cover, our foreign exchange reserves provide around roughly 8.5 to 9 months of import cover. Short-term debt, is only around half our forex reserves. So in that sense, the situation is not so bad. But these are some of the indicators which I'll track.
Okay, great, Ravi. Thank you so much for joining in and for slicing and dicing the GDP in data for us for the quarter gone by, and also for telling us the key monitorables to watch out for from here on as well. With that, it's a wrap. Thank you guys for watching.